There's one ETF the dividend world is obsessed with. I mean, genuinely obsessed. It's one of the most bought dividend funds on the planet, and people talk about it like it's the only dividend ETF that matters. So I did the only thing that made sense. I bought it, tracked it, tested it. And here's the part nobody tells you. It's great, but it's not what you think it is, and it's not for everyone. Here's the thing. By the end of this video, you'll know exactly whether SCHD belongs in your portfolio, or whether you're about to make an expensive mistake. First, strip away the hype. SCHD is not some secret. It's a simple index fund. It's called the Schwab US Dividend Equity ETF. One ticker, SCHD. It tracks an index that holds about 100 of the most reliable dividend-paying companies in America. Not the flashiest, not the riskiest. The reliable ones. Think Coca-Cola. Think Pfizer. Think companies that have paid dividends for years and kept increasing them. That's the whole job. Find steady companies, own them, collect the income. And here's the number everyone starts with, the yield. SCHD pays roughly a 3.4% dividend right now. That means for every $10,000 you put in, you get about $340 a year in cash. Not theory. That's the actual check. But here's the thing, and this is where most people get SCHD wrong. That 3.4%, it's not why people buy it. Not really. See, there are two ways to think about dividend investing. Most beginners chase yield, the highest number they can find. Big mistake, because a fund can have a huge yield today and be a trap tomorrow, cutting its dividend when things go wrong. SCHD plays the other game, dividend growth. The index is built around a strict set of rules. It only holds companies that have paid dividends for at least 10 years, and not just paid them, grown them, every single year. That's the filter. The people who design this fund are saying, in plain English, we don't care what's trendy. We care what's survived. We care what pays us more every single year. And that's why the early investors love it. People who bought SCHD years ago, the yield on their original money keeps climbing. Some are earning over 12% on their original investment, just from dividend increases. That's the power of growth on top of growth. Here's the thing. A 3.4% yield looks boring. A 12% yield on cost over time, that's how passive income actually gets built. Now, the honest part. Because the dividend crowd will tell you SCHD is bulletproof. It's not. Let's talk real numbers. Over the long run, SCHD has delivered solid total returns, price gains plus the dividends you reinvest. It's beaten the broad market in some stretches and trailed it in others. The truth is, a dividend fund like this tends to shine when the market gets choppy. When growth stocks crash, steady dividend payers hold up. That's the safety you're paying for. But, and I want you to hear this clearly, in a roaring bull market, SCHD usually lags, because it's not chasing the high-flying tech names. It's holding boring, steady, reliable companies. Boring wins slow. It wins safe. But when the market's on fire, boring looks slow. Here's the thing. You're not buying SCHD to beat the market. You're buying it to not lose your mind when the market tanks. Which brings us to the question in 1,000 comment sections. SCHD or VOO? Dividend ETF or just buy the whole market? Here's the honest breakdown. VOO tracks the entire S&P 500. Every big company, growth and value, all of it. It has lower fees and historically higher long-term returns. For most people, most of the time, VOO is the more sensible core holding. SCHD is different. It's concentrated in value and dividend-paying stocks. It has a higher yield, meaning more actual cash in your pocket. And because it avoids the hottest growth stocks, it tends to be less volatile. Lower highs, higher lows. So which wins? It depends on your job. If you're decades from retirement and just want maximum growth, SCHD is probably not your foundation. If you want income, stability, and cash that shows up even when the market's ugly, SCHD earns its place. Here's the thing. The people who do this best don't argue SCHD versus VOO. They own both, and let each do its job. Now here's the part that almost every SCHD video skips: taxes. And this is where it gets genuinely smart, or genuinely costly, depending on where you hold it. Most of SCHD's dividends are what the IRS calls qualified. That means they're taxed at the lower long-term capital gains rate, not your normal income rate. In practice, that's a big deal. It can be the difference between keeping most of your dividend or giving a huge chunk to the government. So here's your rule of thumb. If you're holding SCHD in a regular taxable brokerage account, this tax advantage works for you. It's a genuinely smart income play there. But if you're holding it inside a retirement account, a 401k or an IRA, that tax advantage is wasted. Those accounts are already tax sheltered. You're paying no tax either way, so the qualified dividend benefit? Gone. Here's the thing. Where you hold SCHD matters just as much as whether you buy it at all. So let's be honest about who this fund is really built for. Because the best dividend ETF is a meaningless title if it's the wrong fit for you. SCHD shines for people in or near retirement. People who want their money to throw off income they can actually live on. People who are done chasing maximum growth and want dependable cash flow with less stomach-churning volatility. That's the core audience. That's who this was designed for. It also works as a satellite. Not your whole portfolio, but a slice. A steady income anchor next to a growth core. That's actually how a lot of smart investors use it. But if you're in your 20s or 30s, decades from touching the money, and you're putting your entire future into SCHD, I'm going to be straight with you. That's probably a mistake. You're trading away long-term growth for income you don't need yet. You're taking the safe road when you could afford the scenic one. Here's the thing. Fit beats hype. Every single time. Now, because this channel is no BS, let me give you the case against SCHD. Because there is one. A real one. First, concentration. SCHD leans heavily into value stocks, and certain sectors like financials and industrials. If those sectors struggle, your whole fund drags. You're not as diversified as 100 companies sounds. Second, underperformance in bull markets. I said it earlier and I'll say it again. When growth runs hot, SCHD looks slow. If you bought SCHD expecting to keep up with a red-hot market, you will be disappointed. That's not the fund failing. That's you buying the wrong tool. Third, and this is the one people don't say out loud, chasing yield is a mindset trap. If you buy SCHD only because of the dividend, you might be treating a symptom instead of building a plan. Dividends are great, but they're one part of a portfolio, not the whole story. Here's the thing. The people who lose money with SCHD aren't the ones who hold it too long. They're the ones who bought it for the wrong reason. So, is SCHD the best dividend ETF? Here's my real answer, with the BS stripped out. SCHD is one of the best-built dividend ETFs on the market. The rules behind it are disciplined. The companies it holds are quality. The dividend growth track record is genuinely impressive. If you're picking a single dividend fund for income and stability, SCHD is a legitimate top choice. I'd put it in the conversation every single time. But is it the best? Not for everyone. It's not the best for a 25-year-old building maximum wealth. It's not the best for someone who wants to beat the market. And it's not the best if you buy it without understanding the tax angle and where to hold it. The best dividend ETF isn't the one with the most hype. It's the one that fits your life, your timeline, and your goals. For a lot of people, especially retirees and near retirees, SCHD fits. For others, it's just a piece of a bigger plan. Here's the thing. Don't ask, is SCHD the best? Ask, Is SCHD best for me? That's the question that actually makes you money. So let's bring this together. Here's your honest, no BS takeaway. SCHD is a well-built dividend fund. It pays a real 3.4% yield. It grows those dividends every year, and it holds the steady companies that keep paying through bad markets. For income and stability, especially in retirement, it's genuinely top tier. Not theory, that's what it does. But it's not the best for everyone. If you're young and far from retirement, it's probably a slice of your portfolio, not the whole thing. And wherever you hold it, understand the tax game, because it changes how much you actually keep. So here's your one action. Before you buy a single share, ask yourself that one question. Is SCHD best for me? If the answer's yes, great. It's a legitimate, boring, powerful buy. If the answer's no, thank yourself for not chasing hype. That awareness right there is where smart investing starts. If this gave you a clear starting point, hit subscribe. The On Paycheck is your no BS guide to taking control of your money, even when you're starting from zero. We skip the jargon and give you real, actionable steps you can use today. New videos every week. We'll see you there.